All right, today's webinar is going to be about preferred returns for apartment syndications. And so as you have questions, feel free to use the chat box on the webinar platform and type in those questions that you may have. And we'll try to get to as many of those questions throughout the webinar today. And for those of you who have not invested in apartment syndications yet, and you're just kind of doing your investigations, or even for those of you who have maybe taken the dive and actually invested inside of an apartment syndication, we would love the opportunity, myself and our other partners in this in our apartment syndication group called PassiveInvesting.com, and I'll bring up that website here for you so you can see it, the PassiveInvesting.com group, and so that you can actually find some more information about my group. There's a video on there about my background and things like that, so you can take a moment to look at the PassiveInvesting.com page, which, as you can see, is having a hard time coming up right now, probably because of my internet connection of where I'm at. Not sure why we're having so many issues with it, but we will hopefully get this figured out. So anyway, you can go to PassiveInvesting.com. I'll type that into the chat box. For those of you who are watching the recording, I'll make sure that it is inside of the comments box or description or whatever it may be. But I would love to have you click on this button, join the Passive Investing Club, and join us on one of our next offerings that we're going to have available soon. And when you fill out that form, the investor form on our website, I'll jump on a one-on-one phone call with you to discuss your investment goals, to see if our group is a right fit for you. So today we're going to go over these preferred returns, and there's going to be some people that are watching this right now that are going to probably be a little bit upset with me, because I'm going to talk about some things about preferred returns that is a bit controversial, depending on which coach or mentor you have been brought up with in the space, if you will. But I'm going to tell you exactly what we do for our group and why we do them, and how we protect you as an investor inside of one of our offerings. And for those of you who are active operators, you're going to understand and see why we do what we do, so that you know how you should be doing things in your own particular projects or particular deals as well. So we're going to be talking about what are preferred returns for passive investors. We're going to be talking about how preferred returns, or answering the question of, are preferred returns important when choosing an operator? And then why do some operators choose not to have a preferred return? And then how are they calculated, and are the distributions based on the preferred returns? And a few of the things that, for those of you who have been watching my webinars for some time now, you always know I have a few little golden nuggets that I intersperse throughout. So the first thing I want to discuss is, what are preferred returns? Okay, because it can be a little bit confusing if you're a first-time investor kind of looking at these things, because preferred returns can affect a few things. So I'm going to stop this screen here, my screen sharing, because I want to just have this conversation with you. So the preferred returns, and it's going to lock up on me. Isn't that fun? All right. So preferred returns for investors are going to be extremely important. And the preferred return is basically a preferential treatment on cash flows or sale proceeds when you actually exit a property on the sale proceeds, or as you're holding on to the property and on the cash flows that are coming in off the asset. And so those are there's a difference, though, between preferred equity and a preferred return. A preferred equity would be a preferred position in the equity or the capital stack when it comes to when you sell a property, or when you start to do distributions, you get paid first before any other investors, and depending on what class of share you are in. And so there are those preferred equity positions which have a different position in the capital stack structure. But what I'm referring to in this particular webinar is the preferred return, where you are going to get preferential treatment on cash flows or sale proceeds whenever you're inside of an investment. So you're going to get the first set of cash that comes in to protect your downside risk by you getting the first set of the proceeds, instead of having no preferred return. So to give you an example, no preferred return would basically mean, let's just give the example to make the math easy. You put $100,000 into an investment, and when you put that $100,000 into that investment, if there is a 7 or an 8%, let's just make it a 7% preferred return right now. If you have a 7% preferred return, that would be $7,000 a year that you would be getting as a preferential treatment if there was enough cash in the deal to do that. So what happens sometimes is operators will get into a deal that doesn't have a lot of cash flow, and so they'll say there is no preferred returns because there's not enough cash to be able to distribute. Okay, so it should be a lot higher returns for you on the IRR as well as on the annualized return basis, because you actually are putting up a lot more risk by not having that preferred return piece to it. Okay, and so if you have no preferred return, then what that means is that if there is $10,000 one month, or just say on an annualized basis, if there's $10,000 to distribute, then depending on whatever that split structure is with the sponsor, let's just say it's 70-30, which is the kind of split structure our group puts together with the PassiveInvesting.com team. And with that 70-30 split, you as the investor, the investors would get 70%, so they get $7,000 to divide amongst them, and then the sponsorship team would actually get 30%. So they get to keep $3,000. They get to keep that $3,000 before returning or giving any preferential treatment to you as an investor. And no preferred returns are good for deals that don't have a lot of cash flow on them, but they're a lot higher risk. So if you're not really cared too much about any cash being made off the deal, but you're looking for that really high appreciation and high exit, then there should be a commensurate amount of higher exit return for you on the back end. But if you have no preferred return and you still have a lower IRR or a lower annualized return, then you're not really getting the benefit of holding on to an asset that has lower cash flows. So that's one thing you want to always make sure that you're considering and making sure that you're always balancing, is that difference between having that preferred return and not, and where you as the investor get your returns in that particular offering. Now, the next thing I wanted to mention to you is that there are a couple of things with preferred returns that you have to be aware of. So the first thing that you want to look at when you're looking at any offering that has a preferred return is you want to make sure that it is what is called a cumulative preferred return. And I'll explain that in a minute. But one of the other things that I would encourage you to do is, to me and with my investments, I'm currently right now in 19 different syndications that I've invested in. And that's with 8 different operators, and every one of those operators has a preferred return. So I choose not to invest in offerings that do not have a preferred return. So, and I know a lot of our investors do the same thing because they want to have that preferential treatment. Now, if there weren't any preferred return offerings or deals available, then yeah, sure, I might go to a deal that is a lot riskier available. But if I have the ability to invest in an offering that has preferred returns and has really solid returns above 15% IRR, above 17, 18% annualized return, I'm a happy camper. That's what I'm looking for. Okay. But one of the things you have to make sure you're looking for is those cumulative preferred returns. And a cumulative preferred return is a preferred return that if that preferred return is not hit in a particular year, then the difference actually goes over to the next year. And so what that means is that if your projection was a 7% preferred return, and one year you only got 5% preferred return or a 5% return, then that difference, that 2%, will be tacked on to the next year. So the next year you'd have a 9% preferred return. Now, it's possible that next year you might not have the cash to do a full 9%. So let's say that next year things went really well, you got an 8% return on that money. Well, now the next year would still be 8% because your original one was 7, and the difference that year was only 1%. Okay, and so but what that does is it continues to protect you as the investor to make sure that you get your return first before the sponsor gets their return as well. Okay, so that's the difference between a cumulative and a non-cumulative preferred return. I suggest that you look at your PPM documents closely and make sure that you're actually getting a cumulative preferred return. Now, one of the things that you also have to look at is the difference between what is called a true pref or what is called a pari passu type of situation when it comes to these preferred returns. And I'll explain the difference between the two. A true pref would basically be you're going to get 7% off the top, and then the rest is being split with the sponsor. That'd be a true pref. But most operators are going to do what is called a pari passu type of situation, where you're going to get the first 7%, and then before you get anything else on top of that, the sponsorship team would be made whole to their 7% as well. Now, our group does that same pari passu type of activity, but we don't do that pari passu until we actually have some sort of a capital event. Whether we refinance or sell the asset is when we actually make ourselves whole from that perspective. Now, obviously, we're not going to give ourselves any return if we can't at least hit that preferred return, right? And so what we like to do is make sure our investors are taken care of first, because number one, we're investors inside of each one of our deals. We put up to 10% of the initial equity on each one of our deals to make sure we have that alignment of interest. So you want to make sure that you have that you understand which position you have, whether it be the true pref or the pari passu setup, whether you have cumulative or non-cumulative preferred returns. So I kind of discussed a few things about, why do some operators choose not to have preferred returns in their offerings and which ones do. If you look at an offering that doesn't have a lot of cash flow, then obviously that's going to usually be the answer as to why there is no preferred return. But if you look at a deal that has some really good cash flows in it, 7, 8, 9% cash on cash starting in years 1, 2, or 3, then you have to ask yourself, why is this operator not doing a preferred return? And chances are that operator, that sponsor, needs to live off of those cash flows. And it might not always be the case, but that's typically what happens is that the only benefit that it actually has to an operator is that they get to actually have some spread off of those cash flows during the hold period. Our group chooses not to take any distributions from the sponsorship team during the hold period. We leave everything in as operating reserves just in case the deal needs it, and it allows us to be able to continue to maintain sufficient operating reserves in case it's needed. And then we take our return, our pari passu returns, when we have some sort of a refinance or sale. And so again, we're very well financially backed. We don't really need those cash flows on a monthly basis to be able to put bread on our table or food on our table or keep the lights on. We don't need that. So obviously we're still getting our 2% asset management fee to be able to manage the asset. And so that's what we use to be able to hire some additional team members to be able to make sure that we're handling the investments for our investors properly. So those are just a couple of things to think about and consider. And when it comes to these preferred returns, the only person that it really benefits when there's no preferred return is the operator. It does not benefit anybody else. And I would even venture to say that even if you have light proceeds or light cash flows, it still benefits the operator more than it does the investor. And our goal with our group is to continue to grow our investor database and grow our investor family, if you will, so that they do multiple deals. I think that's one of the reasons why we have so many repeat investors in our projects, because we do what we say we're going to do. We perform based on what our projections are, and we've been doing that for quite some time now. And so I'd encourage you, if you're interested, reach out to us. See if we're a good fit for you. Go to passiveinvesting.com, fill out that form. Love to be able to have that conversation with you to see if that'd be a good fit for you. Now, one of the last two questions is, how are the preferred returns calculated? And then, are the distributions that you give out based on the preferred returns? So the first question is the preferred returns are based off of the initial equity. So if you put $100,000 into an investment and you get a 7% preferred return, that preferred return is an annualized basis. So every year that you're into a deal, if you put in $100,000, then you should be getting $7,000 in distributions, or $7,000 in that preferred return space. So that is how you calculate it, is off that initial equity. Now, the next year, it doesn't reduce your equity to $93,000 now. Those are the only time it reduces your equity or your capital into a deal is in some form of a capital event. So it would reduce your amount of initial capital into the deal, doesn't reduce your equity percentage, but reduces your initial capital into the deal, so it reduces those returns, those preferred returns to the investors. Now, it doesn't reduce the preferred returns, but it reduces the number as to where those preferred returns come off of. Now, the last question here was about how the distributions are done. So in our group, we want to do, and we choose to do, monthly distributions. And so those monthly distributions are based off of that preferred return. So if we do that same scenario that we talked about earlier, and we said we have a $100,000 investment with a 7% preferred return, you divide that 7,000 divided by 12, it comes up to $583 and some change. So every month that you're into the project with us, you're going to get a check or you're going to get a distribution via ACH, electronic deposit, for $583 and some change every month that we're into that particular project. Now, at the end of every year, we look back and see where the cash flows are, and if there's additional on top of that preferred return, on top of that $583 a month, on top of that $7,000 a year, that we can distribute over and above that, then we can make that decision and distribute above that as well. But we also want to make sure that we're maintaining a certain level of operating reserves just in case something happens with the property. And if for some reason there is some sort of market correction or downturn, we have the ability to hold on to the property and ride through some sort of a storm if that may happen. So those are preferred returns for apartment syndications. Hopefully this was very helpful to you. Hopefully this was enlightening to maybe opening your eyes a little bit about the preferred return nature of these types of investments. If you have questions about these, please feel free to use the chat box right now. I'll answer any questions that you may have. And I know one of you on the webinar today probably has a question that somebody else is thinking. So go ahead, use that chat box right now and type in any question that you may have surrounding these preferred returns for apartment syndicators, for apartment syndications. And as those questions are coming through, we have probably about another 5 to 10 minutes on the webinar today, because I figured this would probably be a little bit of a shorter one because we're talking about a very specific topic, those preferred returns. So first question coming in: what are typical breakdown / preferred returns that you see? So typically you're going to see a 7 or an 8% preferred return. That's what I look for as a passive investor, because like I said, I'm in some of these deals myself. So I'm usually looking for a 7 or 8% preferred return, and then I want to see a 70-30 split, 70% to the investors, 30% to the sponsorship team, and so that's typically what I see out there. Those are the types of projects and deals that we're putting together. And then I do see some occasionally that will be, you know, a 8% or you know, I haven't really seen a 9%, but I've seen like a 6% preferred return or lower. And I've also seen like different split structures like 80-20 or 90-10. But to me as an investor, when I look at that, I feel like it's a lot harder for that operator to make any money on it. And so I also want as an investor, my operating partner to make money, because it helps them to be able to grow. And I also want them to be incentivized to make sure that the property performs well as well. And if they're having to reduce their splits to make the deal work, it's too tight for me. I don't want to have that tight of a deal for myself. So I look for those 70-30 splits with a 7 or 8% preferred return if I can do it. Next question here: what would be a typical return for no split or preferred return split? So I think if there is no preferred return, I think is maybe the question. If there's no preferred return, then you're going to want to see a lower equity split or a higher equity split on your side as the investor. So instead of trying to look for a 70-30, you're going to want to look for more upside potential. So because it's going to be a ton more risk for you as the investor because you have no preferential treatment. So you want to see probably at least an 80-20, maybe even more than that, like a 90, like an 85-15 or a 90-10 split, because you are going to have that higher risk. Okay. The next thing is, how do I find these preferred opportunities? So Obviously, our group, Dave, is putting together these types of projects. If you'd like to reach out to me, I can kind of discuss with you with what our group, passiveinvesting.com, does, but I can also share with you maybe some other operators that I've invested with personally and give you some of those recommendations from my own experience. Next question is $100,000 the minimum amount to invest with your group? No, we do have a minimum investment lower than that. So our typical minimum investment is $50,000. So if you're interested in that, obviously reach out to us. Would love to have you as one of our operating partners. I would say most of our investors on average are right around 90 to 100,000 in their investment across the board, if I was to average them all out. But the minimum investment is $50,000 for our group. Let's see. So the real money made during capital. Yes, so Norris is asking, so the real money is made during a capital event, not on the acquisition or hold from the sponsor standpoint. Yes, that is correct, Norris. So obviously when you acquire the property, you're going to have that infusion of capital from an acquisition fee standpoint. But when you're holding the property, you really aren't making a lot of money. And to me as an investor, I want my operating partner, my sponsor, to have those wins on the back end, because the better they perform that property, the better they're going to be able to be paid on the back end as well. And so that's another reason why most of those cash flows are done on the back end. Now, again, there are some groups that do no preferred returns, and they're making money during the process or during the hold period, but as an investor, it's going to be harder for that investor to be able to get money out of there, especially if they're having to split the profits right off the bat with the investor. Because you have to remember, as a sponsor, you couldn't do the deal without your investors. So you want to make sure that you're always taking care of your investors, not always just trying to take care of yourself first. So to me, my customer, or our customer in our syndication business, is our investors. So we do everything to protect and to take care of them first before we get paid. We want to make sure that they are happy so they can continue to invest with us. So David's asking, then what about other fees? There are some other fees. So our group does a 2% acquisition fee, 2% asset management fee, and we also have a 1% disposition fee. Now, our group is a little bit different in the asset management fee and the disposition fee, in that we return money to investors first before we actually get any of the asset management fee or the disposition fee. So what I mean by that is during the hold period, if we can't return the preferred return to investors, then we don't take the asset management fee. And when we go to sell the asset, if we don't hit the original return projections, then we don't take that disposition fee either. So we also, again, are giving preferential treatment to our investors, even in our fee structure as well, because we want to make sure that they're taken care of first. Lisa's asking, Dan, I thought you said today that on a pari passu pref equity split that the investor would get their 7% and then the sponsorship would get their 7% before the 70-30 split of the rest of the cash flows. Did I hear you correctly? Not sure how the sponsorship gets 7%. So that is correct. So so to give you an example, Lisa, if that 7% makeup is based off of their 30% ownership. So whatever your percentage was in that to get to that 7%, 30% of that, or over and above that, to make it whole would be given back to the investor. So it's like as if you did a 70-30 split all the way up to 7%, but then they get made whole on their 30% structure up to that 7% before anything else is distributed. Now our group does that as well, but we only do that on a capital event, whether there's a refi or a sale. So we don't do that during the hold period with the cash flows. That is primarily reserved for distributing back to investors. Would you suggest for your first syndicated deal to offer a preferred return? I would highly encourage you to do a preferred return on all of your syndicated deals. And I've seen some groups that have put together projects that have no preferred return, and they've had a lot harder time raising money for it, because as an investor, I'm making decisions on a regular basis on where to place my capital. And so if I have a deal that I'm looking at, and there's your deal, new syndicator, no preferred return, lower splits, lower returns, but then I go over here, experienced operator, has a preferred return, and has solid returns, you have to ask yourself, where would that investor put their money? And so I think that would answer your question as to whether or not you should actually be doing these preferred returns. I would highly recommend you doing that as well. And Winston's asking, do you go in offering a 7% preferred the first year and 8% after? So that's a very good point that you bring up, Winston, because that is a different way to do it, but you can definitely structure your project where you have different preferred returns based on the year that you actually have the property. So for example, let's say year one, the cash flows are a little bit tight. And that first year you can say, well, I'm only going to be able to do a 5% preferred return, but then starting in year two, it's going to go to a 7% or an 8%. You could certainly do that because obviously there's going to be some tighter cash flows that first year. Would you take a 60-40 split if you got a cumulative preferred return if all of the parts of the deal make sense? I don't have enough information to answer that question, James, because it depends on the returns that are being projected on that particular project. It depends on the market. It depends on the asset class, the area of that asset, the class of the area where that asset is situated. And it also depends on the track record of that sponsor. And it also depends on what the preferred return is and whether it's a pari passu preferred return versus a true preferred return. And then it also depends on whether there is a preferred return that actually gets taken in all the way to the sale. So lots of different questions that I would have for you in regards to that particular return. Are your investors only for accredited investors, or maybe are our projects only for accredited investors? So Lorelei is asking, are you allowing more than just accredited investors in your projects? And right now we are. So we do projects that are available and open to accredited and non-accredited investors, but our non-accredited investors do have to be sophisticated. So if you'd like to have that conversation with us, love to have you go to our website, passiveinvesting.com, fill out the form, and love to jump on a call with you and have that conversation further. Jerry's asking, can I invest as an institution or an LLC or entity, or must I invest as an individual? You can do it as either, Jerry. So I would say about 40 to 50% of our investors invest as an entity of some sort, whether it be an LLC or S Corp or whatever the case may be. And then the other portion of it is either invested with a self-directed IRA or 401k, or they are using it with cash as an individual. So there's a lot of different options that you can do when it comes to that. Let's see, in a preferred return scenario, what happens if a property never cash flows as expected and you never catch up on the preferred rate? Don't you still have the same risk as an investor that doesn't have a preferred return? So yes, you would be correct that I wouldn't necessarily have the same risk, because in the beginning, obviously, if the projections when I'm making my decision are based off of the cash flows being there, and then when I get into the deal, if I have no cash, then obviously that's going to probably be the last time I invest with that operator, because number one, they either don't know how to operate, they don't know how to underwrite, or they're just not managing the investment very well. So it would definitely, at that point, when I'm not getting that preferred return and hitting it, it would be a lot riskier for me, or the same level of risk as having no preferred return. But if I get that return coming in, then obviously it's going to be a win-win for my investors first, because again, I want to make sure I'm protecting my investors first, not just always trying to protect myself as the operator while I'm holding the property. I want my investors to get those wins, because the more wins my investors have, the more deals they're going to want to invest with me along the way. If you're a new syndicator or even an experienced one and you start to get new investors under your fold, a lot of times they will not invest in your next deal until they get a return. And so if you have a deal that doesn't cash flow and it takes you 6, 9 months, a year, 2 years to give them their first bit of money as a return, then it's going to be a lot longer time period for you to grow your syndication business, because those investors are probably not going to invest with you on your next deal until they actually start seeing some wins on their side as well. Are you guys close to having another deal to present to investors soon? So good question, Derek. So we have been working on several different deals. 3 of them we recently lost. We will maybe get one of them. We will see on the rebound if the buyer that was awarded the deal doesn't perform. But we actually just last week got a deal that we're looking at and underwriting pretty heavily right now. It's an off-market acquisition in the Raleigh market. And then we also have some deals that we're looking at in some of these other markets that are around us here in the Carolinas, as well as in Georgia and Florida. So thanks for bringing that up, but hopefully we'll have something soon. So thanks for that little question there, Derek. Let's see. Frenchie's asking, can you explain a deal with preferred return, pari passu with hurdles? So it depends on where the hurdles are. Usually the hurdles inside of a waterfall structure that also has the preferred return is going to have the first hurdle as the preferred return. So the other hurdles in the process wouldn't even come into play unless that preferred return was hit first. And so the preferred return would hit first, then there would be a pari passu to that 7%. If there is a pari passu, be pari passu to that 7%, and then the rest would be split 70-30. And then again, and there might be another hurdle where it splits 50-50, and then 70-30 in the opposite direction. So it just depends on how that waterfall and hurdle structure is set up. After a refi, does your group maintain ownership and pay out the investors out of the deal, or you leave them in the deal? So we leave our investors in the deal. And the reason why we do that is because, yes, we could structure it that way, but we want our investors to see and capitalize alongside us with that appreciation in the property. And so we can refi and return some initial capital to the investors or sell, but we want to make sure that our investors are taken care of. So they would maintain their original equity position in the project. If we refinanced, we do not refinance our investors out. What would be some capital call events you would not fault the operator and would consider a repeat investment? That's not really the topic of this webinar, but Ryan, if you have questions about that, shoot me over an email, dan@passiveinvesting.com. We can obviously have a phone call about that and have a discussion about it. So not a bad question there. So last question here, coming up on about 2 minutes left. What's the minimum amount of units do you recommend syndicating? This is a good question. So I look at it more now, and in the beginning I was, minimum 100 units, minimum 10 million in acquisition. And I've recently changed that criteria to not necessarily looking at the minimum number of units, but looking at the minimum amount of acquisition. And the reason why is because you're not paid based on units. You're paid based on acquisitions and the dollar amount of the acquisition. So we were at 10 million minimum acquisition for quite some time. Earlier this year, we changed that criteria to minimum 20 million, and so we've been syndicating larger and larger deals. So I would suggest, trying to set that minimum for you based on where you feel you could actually bring in the amount of money that you can do to close that deal. So it's a lot different question depending on how much money you can bring to the table as far as being able to syndicate it. But you can syndicate a deal as small as $1 million, $1.5 million, $2 million. Obviously, you're going to have to defer those or disperse those costs amongst multiple or a lot more dollars if the larger the deal you go into. So my suggestion is minimum 100 units, though, because it allows you to have those economies of scale, on-site management, and a lot more control over that asset, and a lot less risk for you as an investor from the passive perspective as well. So great questions today, everyone. Thank you so much for joining us on a Monday. We're about 2 weeks away from the Christmas week, and in December 2019. So thank you for joining us. Looking forward to seeing you next month in the January MFIN Summit, January 2020. So you can go to mfinsummit.com to register for that particular summit. And for those of you who are on the webinar platform right now, for some reason is not able to, yeah, here it is. Maybe it'll let me pop this in here into the piece here. Yes, I will be sending out the recording. Hopefully it'll render here in the next little bit, and we'll get it sent out to you as soon as we get it done. And for those of you who are interested in joining us at the summit, I went ahead and typed it into the box there so you can have it and register for that summit. And the prices are going up this Friday. So Friday, December 13th, they're going up to about $100 more. So if you want to lock in the lowest price we have available for it right now, go to mfinsummit.com, register for your tickets, and I'm looking forward to seeing you at the summit. Thank you so much. I hope you have a great week, and we'll see you next week for the next webinar for the Multifamily Investor Nation Summit.